You are 22 years old. You have $1,200. You have already decided you are buying crypto. That part is settled. The question that is going to define the next 18 years is not whether, it is which one. Both of you buy in January 2020. Both of you spend $1,200. Both of you have the same information available, the same Reddit threads, the same YouTube videos, the same fear of getting it wrong. This is where it splits. Path A, Ethereum, age 22, January 2020. Ethereum is trading at $130. You buy 9.23 ETH, not because you are certain, because the thesis makes sense to you in a way Bitcoin's thesis does not yet. Bitcoin is digital gold. You understand that. You also understand that gold just sits there. Ethereum is a programmable network. It is the settlement layer for an internet of value that does not fully exist yet. You are buying infrastructure before the city is built. Path B, Bitcoin, age 22, January 2020. Bitcoin is trading at $7,200. You buy 0.167 Bitcoin. The thesis is clean. Fixed supply, 21 million ever. Digital gold, the hardest money ever created. No company controls it. No government can inflate it. The halving is 4 months away. You are not wrong about any of this. You will not be wrong about any of this for the next 18 years. The thesis holds through everything. That is both the strength and the specific limitation of the decision you just made. DeFi Summer, the first divergence. The protocols you read about, Uniswap, Aave, Compound, MakerDAO, are suddenly producing yields that make every traditional financial product look irrelevant. Every single transaction on every single one of these protocols requires ETH for gas. The demand is structural. You hold. By December 2020, your 9.23 ETH is worth $6,800. You bought it for $1,200. You have not sold a single unit. Path B. Bitcoin has its own extraordinary year. The halving hits in May 2020 as expected. Institutional money arrives. MicroStrategy, Square, then Grayscale, in a way that no previous cycle had seen. By December 2020, your 0.167 BTC is worth $4,700. You bought it for $1,200. You have not sold a single unit. The gap at the end of year one. Path A is up 467%. Path B is up 292%. Both extraordinary. The gap has already started. The peak, the NFT summer. The divergence widens. Ethereum hits $4,953 in November 2021. Your 9.23 ETH is worth $45,700. You bought it for $1,200. The 38 times return feels vindicating. NFTs have driven ETH demand to levels that made gas fees feel absurd. $100 to send a token, $400 to interact with a smart contract. The fees are painful and also the proof of concept. Congestion means demand. Demand means the infrastructure thesis was right. EIP 1559 introduced a burning mechanism into ETH gas fees. The reduction in block rewards, on top of burning gas-based fees, created the possibility of ETH becoming a deflationary asset for the first time. Path B. Bitcoin hits $69,000 in November 2021. Your 0.167 BTC is worth $11,523. You bought it for $1,200. The 9.6 times return is extraordinary by any traditional asset standard. You hold. The gap at the end of year 2. Path A has $45,700. Path B has $11,523. Path A is 4 times larger. Same starting amount, same entry year, different asset. The crash, the merge, the most important year. Both paths crash. The Terra/Luna collapse in May, the FTX collapse in November. Bitcoin falls from $69,000 to approximately $15,800. Ethereum falls from $4,953 to approximately $879. But 2022 is not just a crash year for Ethereum. It is the year of the most technically significant event in Ethereum's history. The merge was executed on September 15, 2022. This completed Ethereum's transition to proof-of-stake consensus, officially deprecating proof-of-work and reducing energy consumption by 99.95%.
Ethereum stopped being a currency issued to miners who sold it to pay electricity bills. It became a yield-bearing asset secured by stakers who earned rewards for holding it. The merge happened at the bottom of the worst bear market in years. Nobody celebrated. The price was $1,300 the day of the merge. But the change it made to the asset's economics was permanent and immediate. Path A, your 9.23 ETH at the bottom of 2022 is worth $8,117. You held through an 82% crash from the all-time high. You also now hold an asset that has just become structurally different from what it was when you bought it. Better, not in price, in architecture. Path B, your 0.167 BTC at the bottom is worth $2,638. You held through a 77% crash from the all-time high. The asset is unchanged. Same supply, same architecture, same thesis. The crash did not alter the asset. You hold. 2023 to 2024, the recovery, the ETF, the staking yield. Path A, Ethereum recovers through 2023. The ETF for Ethereum is approved in the US in May 2024. Institutional capital enters through the same door it entered for Bitcoin. Your ETH now earns a staking yield of approximately 3.5 to 5% annually. The 9.23 ETH you bought for $1,200 is now generating passive income simply by being held in a staking validator. The infrastructure thesis has added a yield component that Bitcoin structurally cannot match. Path B, Bitcoin recovers through 2023. The Bitcoin ETF is approved in January 2024. Following the April 2024 halving and the launch of US spot Bitcoin ETPs, which drew significant institutional capital toward BTC, Bitcoin rose roughly 16% through March 2025. The Strategic Bitcoin Reserve Executive Order in March 2025 adds a sovereign demand layer that no previous cycle had. The thesis keeps getting validated by events that Path A's asset cannot claim. Age 30, the midpoint. Path A at 30, your 9.23 ETH bought for $1,200 in January 2020. Current ETH price approximately $2,130. Position worth approximately $19,660. Plus staking rewards accumulated since the merge, approximately 0.9 additional ETH earned, bringing total position to approximately 10.13 ETH worth approximately $21,577. The staking yield continues accumulating daily. The asset earns while it holds. Path B at 30, your 0.167 BTC bought for $1,200 in January 2020. Current BTC price approximately $95,000. Position worth approximately $15,865. Bitcoin earns nothing while it sits. The value is entirely in price appreciation. The asset does not compound through yield, the gap at 30. Path A has approximately $21,577. Path B has approximately $15,865. Path A leads by $5,712, but the dynamics that produce that gap are about to be contested by forces that did not exist in 2020.
Over the full decade ending April 2026, Ethereum narrowly edged Bitcoin on raw cumulative total return, approximately plus 18,030% versus Bitcoin's plus 16,200%. On an annualized basis since 2017, Bitcoin has compounded at approximately 50% per year compared to Ethereum's approximately 33%. Reflecting Bitcoin's superior consistency across full market cycles. Ethereum's extreme outperformance in specific cycles, particularly 2020 to 2021, and its deeper bear market drawdowns compress the annualized figure. Ethereum outperformed in the 2020 to 2021 cycle by an enormous margin. Bitcoin outperformed in the 2023 to 2026 cycle when institutional capital, the strategic reserve, and the halving combined. Ethereum's staking yield adds a compounding layer Bitcoin cannot offer. Bitcoin's supply certainty and sovereign reserve adoption add a stability floor Ethereum cannot claim.
Path A chose the higher volatility asset with the higher peak returns and the yield component. Path B chose the lower volatility asset with the stronger institutional narrative and the fixed supply certainty. Both paths made money. Both paths made extraordinary amounts of money relative to any traditional asset class. The question was never which one was right. The question was which one matched who you were. Age 40, the gap that will not resolve. Path A at 40, 18 years of staking yield accumulated. ETH compounding through 4 complete market cycles. The infrastructure thesis validated by trillions in DeFi TVL, tokenized real-world assets, and Layer 2 adoption that made Ethereum the settlement layer for a significant portion of global digital finance. Path B at 40. 18 years of the hardest money thesis validated by sovereign reserves, institutional adoption, and a fixed supply that has not changed by a single Satoshi since January 2020. Both paths at 40 are holding something worth multiples of what they started with. Both paths made a decision at 22 that most people in their city did not make. Both decisions were correct. Both had moments when they looked wrong. Both required holding through the specific weather that each asset generates, and Ethereum generates different weather from Bitcoin. The gap between Path A and Path B at 40 will depend on cycles that have not happened yet.
On upgrades that have not shipped. On institutional decisions that have not been made. On halvings that have not arrived. On regulations that have not passed. What is not in question is what each path cost at the beginning. $1,200, January 2020. The same amount, the same city, the same checking account. The only thing that was different was the answer to a question that both paths answered before they fully understood what they were answering. Bitcoin or Ethereum? The answer you gave at 22 is still compounding. So is everything it was right about. So is everything it was wrong about. That is what 18 years of one decision looks like.